Hey traders, it's Red Ben with a new educational video on how I use my Voodoo range to take profits while trading futures. You can follow me on Twitter at RedBenTrader to get the Voodoo range and the associated levels for all my favorite futures products every weekend. Before we get started with the video, it's important that you read this legal risk disclaimer. Basically, it says that this video is for educational purposes only, that I'm not a licensed financial advisor, and that you can lose a lot of money trading futures or any other financial product. I'm not selling or suggesting anyone buy any specific product, and recognize I am not licensed to make those kind of recommendations. So please do talk to a licensed financial advisor first, but feel free to enjoy this video as long as you agree to this risk disclaimer. So what is the Voodoo range? It is a proprietary mathematical method that I use to figure out how far the mean reversion algos expect the market to move or in each rotation before each turn. So all the levels that's produced by the Voodoo range are equidistant. You can add or subtract the Voodoo range itself for any product to or from any level to get the next level. So I'm only using these for futures and cryptocurrencies, and I apologize to stock traders. I am not, or ETFs, I'm not able to provide Voodoo range for any of those products, just futures and cryptocurrencies at this time. It is updated every week, and I share it for free on Twitter. The ESNQ, RTY, and CL futures contracts. You can take a look at the current contract, where the Voodoo range is, where the levels are. It's important to know that when each Voodoo range is updated, that the newest Voodoo range or VR levels will be the most accurate for the following week. You can still use old VR levels and they won't be useless, but the current ones will be the best. And they are useful from Sunday open to Friday close. An example of what the Voodoo range and its associated levels look like here on CL. You can see dashed lines at each VR level. I've got the yellow values of each level highlighted here, so it's easy for you to copy. Now, these are from last week, so don't go copying your chart with these levels. I will have new levels posted on Twitter probably tomorrow, but I'm using last week's levels to show you what I did and how I watched and observed and made decisions on these markets over the last week. So in this case, the CLVR was 2.21. So each one of these levels are 2.21 points apart. They're equidistant. If you need more levels, you just add 2.21 to this one or subtract 2.21 from that one. You can see that sometimes the market responds to these levels and sometimes it doesn't. But when the market doesn't respond to a level such as here, the next time it tests it, it usually does. For instance, here it goes through an impulse move with a lot of momentum, comes back and has a rotation or a reaction here. So that's something interesting to watch for, and I'll show you some other ways to use it in just a couple minutes. So what I use the Voodoo range for is not to place resting orders on to enter or exit my trades. I actually just observe them and how the market is responding to them. What I'm really looking for is the market defending the levels? And it will only happen in certain conditions. So usually I'm using them primarily for determining targets and to figure out what phase the market is in, if we have momentum, if we're balancing, etc. Recognize that it is not profitable to enter a trade every time the market touches a VR level. I don't use it this way, and I certainly would not recommend that anyone else try to do that. There's just too many levels to try to enter every time we touch it. It would destroy an account very quickly. You want to watch for things such as two-sided trading, or is it one-sided momentum, which would suggest that one side of the market is trapped. You want to look and try to determine if mean reversion algos are defending the level, and I'll teach you how to do that in just a couple minutes. And then you also want to look and see if the market's unable to reach a level before showing signs of reversing. So in addition to the VR levels I share, you can get more levels if you need them, especially for intraday, by finding the midpoint of each range. I use the space that is 50 to 61.8% between each range. So it's the midpoint and then just a little further than midpoint. And I do that between every range, especially since I primarily day trade. And with futures, I exclusively day trade. And I often need to decide whether or not I need to make observations and decisions between levels. So I don't want to just wait until the market goes back or forward to the next or previous VR level. I'll use the midpoint instead. In addition, I can show you how to draw fib extensions and retracements to find other inter-range targets. So, and those are primarily, again, to look for reactions, to observe, not necessarily to trade. So when I talk about observing midpoints, I know this is a lot of lines, so I'm sorry it's a little bit overwhelming. I've removed the volume because I thought it's plenty of things to look at here, but realize volume is also important. But all I want to show you in this example is if you look at every VR, right, every Voodoo range level, this happens to be ES, so they're all 19.75 points apart. Each of these highlighted levels are VR levels. The tighter dash lines here are the midpoint and the 61.8% retracement between each line, or between each level, I should say. Each range, the midpoint of the range. And if you start here and you look to the right, you'll see reactions on both the Voodoo range levels themselves, as well as a lot of the midpoints. And that is just a phenomenon that happens all the time, every day in the markets. I will explain how to use that knowledge. But first of all, I just want everyone to see how the market responds sometimes to these levels, whereas other times it just flies right through them, right? So, but if you look at the left of the screen and you follow each line to the right, you'll see at least one reaction on the midpoint, and you'll see at least one reaction, if not more, on the actual VR level. So you just don't really know when that's going to be without further information. So one piece of evidence that the mean reversion algos are defending a VR level is when you see either a test reject of the VR level or the midpoint between the levels or the fib extensions, as I just explained, especially when they're on high volume, or if the market probes beyond the level, but it fails to close a candle beyond the level. And I'm specifically talking about candles that are at least 30 minutes, so actual periods, 30 minutes, 1 hour, 2 hour, 4 hour. These are the ones I usually use. When you see either of these, either the test reject or the probe beyond, yet no close beyond, it suggests that the market is potentially exhausting. It does not mean that a trend is reversing or that momentum has ended. That's very important to understand. What it usually does mean is that the market is ready to make a retracement or a counter trend move in the opposite direction, approximately one Voodoo range. So for instance, if the VR is 12 points, like it was on RTY last week, if I saw some signs of exhaustion, such as a test reject of a level or a probe beyond, yet no close beyond a level, I would then prepare for a 12-point rotation back the other direction. So keep in mind that just because you usually see one VR retracement, the market absolutely does extend further than one VR, especially when that move is done as an impulse move with increasing volume. So just because you've seen the market move one VR does not mean it's time to stand up in the way of the trend and try to fight it. Don't do that, please. I certainly don't. You do need further evidence to choose to enter a reversal trade, in my opinion, beyond just seeing that one VR retracement. But knowing that the one VR retracement is very healthy and very natural will help you better analyze what's happening in each market as it meets these important points at the VR level and at the midpoint. So an example of how to draw the fib I do things a little bit differently. Normally, what people do the traditional way is to anchor the fib, one at a swing high and then another at a swing low, maybe here or here. And then you get fib extensions beyond that. And so what I've done is just to be a little bit more creative, and I find it just more useful, is if I see we're going in if we're going in a bearish direction from left to right, if we're moving lower, and if we have recently moved beyond a VR level such as 15,134.75 and come back, tested it, and gotten this test reject or a probe yet no close beyond, some of that exhaustion is evident, I will then draw the fib, I'll anchor it from a swing high. You could use this one or this one. And then the other side of the anchor actually goes on that previously tested VR level. So what you end up getting then is these additional lines beyond just the midpoints, which I don't have drawn here because otherwise it'd be pretty overwhelming. But just realize if you take a look here, like I pointed out, these last three ended up having some nice reactions here, here, and here. So it might be helpful to have these on your chart, like I said, when you've already identified that the trend is lower and that you've retested that level, so you know, and you're below it, so you know that you're gonna that level, it becomes significant once you do that. And then, like I said, what swing high you choose in this situation would just be any swing high that is relevant to you and that does not align with a VR level. Because if it does, like if I use this one, all of my extensions are going to be at other VR levels, so it doesn't really add any value. But this one was about at a midpoint, so that's something I haven't honestly studied to see which swing high or low is the best. But I do find no matter where I anchor it, as long as one side is to a previously retested VR level and the other one is to a swing high or low, that I do get some really nice reactions to the extensions or negative extensions. An example of some more examples of the test reject are with the blue arrows here. So you can see we are in a bullish trend. We tested the 2137.1 VR range, VR level, sorry, and moved back 12 points, which on our TUI last week was 1 VR. So the range of this retracement, this pullback, was approximately 12 points or more. And so it makes sense once you've seen this to expect that pullback. There's another one here where you test here but reject, and then you'd expect some sort of a pullback. Here's another one where you didn't quite reach it, but it's basically testing the general area. It doesn't have to be exact, but you can see it's trying to get there. They're just lining up and front running that level. And you do get at least one, if not two, VR an extension at least one or two times the Voodoo range. Here's another one. Here, this one went two. So the other thing I have here in orange is the rejection, the test reject of the probe beyond of a midpoint. So here we probed slightly beyond it, but we're unable to close beyond it on this red candle. Now you wouldn't know for sure that happened until it closed, right? So once it closed, what I'm then looking for, since it's already one VR lower, right? We've gone to it from a midpoint to almost a midpoint. I'd need at least a pullback, and I'll explain that in a minute. But here, here's where I'm actually taking profit one way or another, whether or not I'm getting it here or anytime earlier. I'm taking most of my profit here, and then my runners hopefully get off somewhere down here. So here's another one, test reject at the midline. So at this point, I'm thinking lower. I might not get in right away, but once I see this probe reject, I know it's coming lower. I should say I'm confident it's coming lower, and I end up to be able to get a 1 VR retracement here. So those are just some examples of, like I said, how to predict where price is going to go and when. But again, it comes from observing this first, not trading the level, but observing what's happening there and then knowing the tendencies. So there are two different types or phases of market activity from my point of view. I use a little bit of different lingo just because a lot of times people misunderstand the traditional lingo, and I mean something slightly different. So I've developed my own terms. For example, a trend with momentum, I call agreement. An example of a trend with momentum or an agreement phase would be seeing rotations that extend twice the Voodoo range or more. So it goes beyond the ceiling or floor VR level that it was testing or using as resistance or support before. And this is especially the case if I recently got a retest of a VR level. And that would tell me for sure that we have some momentum in the market. What's happening when there's a trend is that participants are joining in, oftentimes on the pullback, possibly at the Voodoo range or at the midpoint, and they are seeking out liquidity further away from the current price. And they do this, in my opinion, because traders from multiple time frame are in agreement that price currently is unfair. It's either too expensive or too cheap. So the market needs to move away, usually at high velocity, in just one direction, since they all agree on that direction until more fair prices are found. So that's why I call it an agreement phase, because everybody's in agreement with which direction we are headed for the time being. Obviously, these phases shift and gain and lose strength over time. This is always a dynamic process, but it's important to know what an agreement phase looks like, so you know when to use certain trading techniques and when not to. So another example or more evidence that we're in an agreement phase or trending with momentum would be a market that's not able to pull back into that counter trend retracement of a full Voodoo range. So again, if the Voodoo range was 12 for the week on that product, if we only pull back 6 after breaking out, I know, or at least I'm very confident, that we are now in a trending condition and the market is in agreement across multiple time frames. So I'm looking for certain types of trades to develop. It can continue a lot more than twice the Voodoo range. It's really important not to fight the trend once you see that the market is doing this, when it's extending in one direction 2 times the Voodoo range. You do not want to be stepping in front of the market. Keep in mind, if the algos at this point aren't defending the levels, if we're breaking through VR levels, there's really no reason for us to do that either. We should let them make the mistakes first and then take advantage of their simplistic system, in my opinion. So how do I trade momentum? I use a trend following technique when I know that all time frames are in agreement. So when I see one time framing, when momentum phases are identified, my entries are going to be on pullbacks into the levels that I identified with the method I'm sharing. So the VR levels, the midpoints, the fib extensions, etc. So these pullbacks then that respect those levels, they are great places to enter or re-enter if I've recently taken profits. So this will work especially well if the retracement to that recently broken out level is on lower volume than the impulse move itself. This is something a lot of people seem to ignore, although it's taught early on in technical analysis. But if you think you're looking at a retracement, but your volume is increasing compared to what you called an impulse move, you're probably wrong and the market's not trending. So I should be clear that this is the only time, the only phase where Voodoo range levels should be treated like traditional support and resistance, where you can enter when we retest a level. Basically, that's not something that happens in any other phase, but when we are trending, it works rather well. So just as an example here, we have a bullish trend that begins, I'm saying it's beginning here. Technically, it could begin lower, but you can see we had resistance here, and this is some sort of a balance phase. It backside tests or retests or rebids the 2077.1 level and then pushes forward. And it appears to exhaust here. So if we were continuing to balance, I would expect a 1 VR retracement. Well, here we're unable to get that retracement. We only go, rather than 12 points, which is the VR for RTY this last week, we only went about 6 points and then pushed forward. So again, I'm not waiting here expecting to enter. I'm actually waiting for this retest here of this breakout level to get long, and then holding it, expecting at least twice the Voodoo range. So in this case, 24 points up here. So then we get another, this exhaustion was a probe beyond close, not beyond. And then we pull back, and you can see here again, we're finding some support in the middle of a range, even though this breakout started at a Voodoo range. we're getting these pullbacks into the midpoint. So right away, that's a sign that it's probably going to continue. Here again, we have exhaustion. This one's just a test reject of this Voodoo range level quite precisely, which happens a lot. And what do you know? It pulls back one Voodoo range, if not more. So once I see this, I've confirmed that that exhaustion basically tells me that the trend needs some rest. It doesn't mean it's always going to reverse. It just needs a little bit of rest at least. So I'm no longer buying retracements into the level like this, for instance. I'm not looking for this, or if this was the midpoint, I'm not looking for this. If I looked into faster time frames, I might find a pullback into here. This one was a little bit sneaky. They're not all going to work. But the point is, by this point, I'm no longer looking for pullbacks to enter the bullish trend with a trend following technique. So an example of the bearish version of the momentum trading I'm doing, this is actually the same chart, just a little bit later. So you can see here, we started going lower. We we broke through the 2125 0.10 level here, and then backside tested or on a reoffer, we retested here and basically tested and rejected it. So right here, I know that this is the ceiling Voodoo range level, and I can get short as soon as I see this start to go lower. So because we've already broken down through it and retested it without getting a close beyond it. And in this case, we didn't even probe beyond it, so I can just get short right away. So you can see here, it looks like we're possibly exhausting. And so I might take a little profit here. And as it comes back, again, if this is balanced, it's going to come back to here. But instead, it only comes back maybe 6 points or so and starts to go again. So here I'm looking at a breakout trade just based on the candles and knowing that I want to get short. I might get the breakdown and sell it here. Here's another one, right? You get probe and no close below. It didn't come back to get me in, so I didn't mark it because I realistically probably am not trading that. Then here I do see potential exhaustion. It didn't quite reach the Voodoo range level, and it comes back and breaks this Voodoo range level. So here I'm taking profits on any weakness in the chart, knowing that some sort of a phase change is probably happening. We're probably resting, consolidating, reversing, or not going straight down with increased momentum. Most likely this volume decreased here, but again, I've taken up the volume just to keep things simple. Once we've pulled back all the way to a previous VR level here that was retested, see that? We've now come back to it. We've confirmed the phase change and now should be looking at a different type of trading. So what do you do when you're not in momentum or you're not in agreement? And to know that, you need to understand the other phase, which is balance, or what I call negotiation. So balance is the natural state of the market. It's what the market does most of the time. We tend to remember the trend days because they're exciting, but they are actually rather rare. 2/3 of the time, we're just balancing. But I find the term balance is misunderstood. People think that it's a stagnant state, and it really isn't. It's a very active state where a lot is happening. People are repositioning. So I like to describe it with the word negotiation. And this is just my own term. I think it just explains things a little bit better. But what negotiation describes is a situation where you have an absence of momentum and no directional agreement between participants on multiple time frames. So when you're in balance or negotiation phases, the algos are negotiating price levels by rotating in alternating directions, back and forth, back and forth. And they're doing this because they're targeting liquidity that's sitting at the edge, both edges of the sides of the market, the edges of the market. So in other words, they are stealing the stops that traders place under swing lows and overswing highs at points of exhaustion. So the price action in balance is typically confined to a range of less than 3 times the current Voodoo range. So if the Voodoo range for the product is 2 points, rotations in the negotiation phase should not stretch beyond 6 points. If it does, we're probably trending. So usually there are, I consider 2 different types of negotiation. there's a consolidation type and an expanding type. So consolidation type negotiation is when the price action is confined to just one Voodoo range. It's bouncing in between a floor and a ceiling Voodoo range level, primarily. It can move beyond it, but it's usually rejected. 9 times out of 10, it's going to reject back and it's going to trade into the other side, or at least into the middle of the two floor and ceiling levels. And that will continue until you get a breakout that happens on high volume and get some follow through. So an example of how this works is similar to how a marble moves in a funnel. If you've ever dropped a marble in a funnel, the range that the marble moves contracts until it gains enough momentum to fly through the hole. So that's how the consolidation type negotiation builds energy to be able to break out and become a trend, or potentially become a trend. On the other hand, expanding negotiation is when price action expands in range in both directions. Typically, what you'll see is a rotation around a Voodoo range level, or an orbit of a Voodoo range level, rather than getting confined between two levels. The center of the rotation will be a Voodoo range level. So this phase tends to produce failed breakouts in both directions, and momentum builds by trapping traders at those edges. So the price action during the expansion type negotiation works like a rubber band, where one side pulls, then the other side pulls, and then the first side pulls again a little harder until one of the sides break, and that's how you get the breakout. So when it's consolidating, when you have price confined primarily between two Voodoo range levels, I am using a mean reversion strategy. I'm looking for exhaustion points just beyond the floor and the ceiling Voodoo range levels for entries and final exit targets. But I'm primarily taking most of my profit at the midpoint between that floor and ceiling VR level. And that way I'm paying for the risk of when the trade doesn't work, because oftentimes it doesn't. I am holding a runner most of the time, and if I get a probe beyond the floor or ceiling, I'll collect profit on the runner. So it's important to recognize that because you're using a mean reversion strategy, you're not trying to catch the bottom of a trend. You're not trying to get the reversal that goes twice or 3 times or 4 times the Voodoo range. You're just looking for that one VR trade. So if you're trading RTY like last week and it had a 12-point VR, I'm looking for 12 points max, and oftentimes 6 points. Recognizing this, you need to manage risk, especially with mean reversion strategies, because every time you use it, if you keep applying it to the same location, one of your trades will be a loser. That last trade will end up breaking out and will stop you out. If you don't use a hard stop and instead you let the market move impulsively against you, you could easily wipe out all your gains from the time you spent with profiting in the mean reversion strategy. So it's really important, no matter what, to use a hard stop. In my opinion, I always use one. But no question, with the mean reversion strategy, you must. So here's an example of CL. Last week, the VR was 2.21, and I've highlighted some consolidation negotiation phases with these orange rectangles, and my locations for trading are circled in red. So this, for instance, and these edges, that's where I'm targeting for entries, and then the midpoint is where I'm getting most of my profit off. And then if it happens to go a little further, I'll release the runners here and then look for a reversal. Again, this last reversal got to the midpoint, but the runner got stopped. And that's usually what happens. You might get in here at the retest, get some off at the midpoint, and then here you happen to just about get paid on the runner. I probably would have taken profit as it comes back this way, but if you didn't, you might get stopped. And then here again, if you got short here after seeing this, you'd get paid on your midpoint, which, like I said, I'm taking about 2/3 there. And then I'm trying to take profits as soon as we probe beyond and don't close beyond. So I'd be covering here because I don't want to have to hold through this. Even though it goes a little further, I'm not really expecting anything like a 2 VR move. This happened to occur here, but I'm not interested in that unless I think that it's trending lower. So here's another one. It's testing here and testing here. So these are entries and exits or targets, and my primary profit target's at the mid. So that's an example. Now, what does expanding negotiation look like? A lot of people misunderstand this. I think it's a really complicated concept. So this is a good example of it. You can see price begins with a tight rotation around this VR level, 101.74 on CL, and then it slowly expands in range. See that? It goes further and further and further and further. So what you end up doing is people think it's expanding, so they think it's trending. They buy and they put a stop down here and they get stopped out. And then they think, oh, okay, it's short, so I'll put a stop here, and then that gets stopped out. So it's really hard to trade. And it's also just difficult sometimes to identify. So if you're a newer trader or you don't have a really strict mechanism for finding trades in a balance phase, you should really not be trading as soon as you recognize an expandatory negotiation. Just step out of the way. You know it's happening because you're getting range that's expanding, but you're not building momentum in one direction or the other. Price action tends to be really choppy, and typically it develops around an HVN, a high volume node. And it happens a lot when we open in the same range as the previous day. So if we close at 100 and we opened at 90, we close at 100, and now we open the next day at 95 or 98, the chances of expandatory negotiation are higher. And you're going to do it probably around the VPOC or a Voodoo range near the VPOC. So the tall tale sign is the market orbiting around the VR level with tight rotations that then probes beyond the midpoints and then beyond the nearby floor and ceiling level until you have almost a 2 or 3 times Voodoo range rotation. And then eventually you get a breakout. But before that, you usually get a lot of fake outs where people get stopped out. So what do you do in this situation? Well, what I do in this situation is, first of all, I use what I call a second mouse strategy, or I identify a pivot to limit the number of entries and avoid the chop by only entering on the edges. The second mouse strategy is basically where you wait for the market to stop out a trader beyond a typical visual swing high or low, and then you follow them, you enter the trade in the same direction as they were trading when it goes back through their stop. So it's important to be really nimble and take profits super frequently if you are going to trade this. Here's an example of the second mouse strategy. So the red is where traders put their stops. So I kind of mentioned this before, but let's say a long bias trader puts their stop here after seeing this break over the Voodoo range. It's not exactly the way you're supposed to trade, in my opinion, but let's say that's what they did. They put their stop here. I'm not getting long until the market passes that level like this and then bounces, preferably off a Voodoo range or a midpoint like this. Once it passes back through it, especially with high speed or high volume, some kind of order flow confirmation that things are going a little higher, or at least making some sort of a upwards rotation, I'm looking to get back to this 45.23 level, which is where we're orbiting. So see how it's expanding, but it starts with this tight range around that Voodoo range level and expands. So another example, here's a short. So this guy shorted here, thinking he's clever. He's going to short that midpoint between these two VR levels. If he was clever, he'd get out here, but maybe he thought it was going to go lower, and it comes back and it stops him out there. So if I saw that now, I'm sorry. Actually, the way this works is here. So it comes down and it bounces first. And so it takes him out, and then I'm looking to get long back in here. I'm sorry, to get short back in here, the same direction he was trading. So if he got stopped out after putting short in, I'm getting short when it comes back through his stop. And I'm getting out probably most of it here, and then holding a runner for this one. It'd be nice if I got this mid, but I don't know if I would. Here's another one. So this guy he gets short here. He puts his stop behind it. The market comes back, takes him out, and then I can get short, again, only when it goes through this. So I'm getting short here. or here. And then I'm targeting this level and then holding a runner. This long, maybe he gets long here but holds, and if he puts his stop here, even if he gets long up here, but puts his stop behind this swing low, that swing low gets stopped out. And now if we pass through that, especially when it bounces off that midpoint, I'm getting long. And again, I'm actually exiting a lot here and then just exiting as we get higher. I'm not looking for a trending market. I'm just looking for an expanding range. So a little bit further each time by getting long or short, further and further from the edges. Again, it's not an easy strategy, and most people are probably better off not trading it. But another way you can trade it is by finding pivots. One way to do that is with what I call a technique I call constricting volume and range pivots. So what you're going to do is you're going to identify 2 consecutive candles on any time frame, preferably over 30 minutes or higher. And these 2 candles have to close in opposite direction. Doesn't matter which one is which, but one has to be bullish. The other one has to be bearish. And the second consecutive candle has to have a smaller range of the distance between the high and the low compared to the first one. And it also has to have lower volume than the first one. So when you see that, what you want to do is mark off that range of the candle grouping, so the high to the low of those 2 candles, and then extend that to the right, which I'll show you. And then you're going to watch that same zone for future pivots. So this works the best when there is a VR level or a midpoint between VR levels contained inside that pivot range. So you definitely need to see, or I at least need to see, a candle close after defending that VR level inside the range. I don't just jump on because it tested the area. I need to actually see it defend and like reverse pivot there. It's important that the close of the candle does not close beyond the range. Only the wick can go beyond the range. So if you want to increase your win rate with this technique, wait for a retest that holds of the VR level or the midpoint level. So here's an example. So we have a green candle immediately followed by a red candle. That red candle has lower volume, and that red candle has a smaller range. Actually, you could even do this red one and this green one, which I think is what I've done. So the second candle's green, the first one's red. There's lower volume on the second candle, and the range is smaller. In this case, it's an inside candle, so it's very clearly the smaller candle. Then I'd take the low to the high of the group, and I'd extend it right. And if I get wicks that go beyond but closes that stay within, I expect some kind of a retrace or rotation back. Here's another one here. You might not be able to get long until it gets up here, but it's still, the concept is still valid. Here's another one. So you've got a small green candle followed by a small red candle. Again, it can be red then green or green then red as long as the 2 are closing in the opposite direction. The volume is clearly decreasing. And in this case, even though it's not an inside candle, the second candle has a smaller range than the first. So I'd take the high of this first green candle and the low of the second red candle, and I'd extend it to the right. And then I get some reactions here at this VR level, this 2089.1 level. So once I get this retest here, like a probe failure to close beyond it, and then a retest and fall, that's a short for me. This one isn't quite yet. I don't know. It would have to close red here for me to get in. So yeah, that's another way you can trade expanding negotiation. So another way, and this can actually work in trending markets as well, is finding pivots with Hall MAs and when the Hall MA crosses the Voodoo range level. So to do this, I'm placing 2 Hall moving averages on my chart on any time frame. The lengths for the HMAs need to be square rootable, numbers that can be square rooted. And the longer HMA has to be twice the length or more than the faster one. So I use the 64 HMA and the 25 HMA. So what I'm doing is I'm finding spots where the 64 HMA cross the VR level, but price is not crossing the VR level at that same time. I'm highlighting that bar, like vertically, that time. And then I'm marking the actual value where the faster Hall moving average was at that same bar. And then what I do is I extend that level to the right, and I expect that sometime when price returns to that level where the 25 HMA was, when the 64 HMA crossed the VR level, I expect price this time to react in that at that spot. And you might think it doesn't work, but it does. So here's an example. The VR, the 64 HMA is these circles, and the 25 is the orange line. So the 64 is crossing the Voodoo range level here on the red arrow, and the green line shows the bar. And at that same time, the 25 hull moving average is here. And so if you extend to the right, you get a nice reaction there. And in this case, you're trending, so you get long even. And it also happens to be about a midpoint. So that's nice. Again, I didn't draw that in, but you can sort of see it's halfway in between the two. That always helps. So here's another one. So the 64 falls through the Voodoo range level. I'm taking this bar here, this red bar, and I'm finding where the 25 HMA is. I'm transferring that level straight to the right, and you can see we have a couple reactions here from price. Again, it's at the middle of the VR here. So here's another one. 64 HMA crosses under the Voodoo range level. I find that bar, and I look down here. This is where the 25 HMA is. I transfer that to the right. I'd say it's down here. That arrow is not quite right. It's actually this. So my apologies. It's this reaction here, just above, but not quite halfway. So that's another method you can use. So why does this work? Why does all this equidistant stuff work? So in my opinion, my theory is that the mean reversion algos that steal your stops and collect liquidity are using machine learning to adjust their strategy and their expectations of how much volatility will be in the market from one point to the next. They are clearly constantly adjusting. They're constantly adjusting, and I don't know a way to know what they're doing. But what I have figured out on my own is that there are what I'll call observable artifacts in order flow and price action once those adjustments are made. So even though they're continuously learning, I'm only adjusting the range once a week just because that's all the precision I need to trade. And it honestly is kind of cumbersome. I do this manually right now. But recognize I'm the only one using this method. It's totally unique. It's non-traditional. No one showed me how to do it. I just figured it out on my own with a lot of testing and data collection. And I definitely recommend anyone who wants to explore the Voodoo range does this same research. Compare it to random levels, random ranges, see if you get the same reaction. Because in my experience, it has been completely validated that it is not just a random trick, like parlor trick of your eyes, that your eyes just go to where the levels are, because there are clearly reactions at the levels and the midpoints. So like I said, whether or not it's actually what I think it is, I don't know, but what I can tell you is it's working really well for me. I am not going to share the formula for how I come up with the Voodoo range this time, primarily because I don't have it automated. Right now I'm doing it manually, and I don't want someone to steal the idea, rebrand it, and then sell it to y'all. So instead, I'd like to just provide it for free to my Twitter followers, at least until I have enough data to automate the system. I figure I'm using it, and it's fun to see what other people do with it. But eventually I might end up turning it into a automated system that I sell. But for now, it will be free. And really all you need to use it, at least all I need to use it, is this information I just shared and the actual updated levels, which I share on Twitter every weekend. And those levels are good all week long. Again, you can follow me at RedBenTrader on Twitter, and I appreciate you guys sticking with me through this long video. Hopefully you learned something. Let me know how this is all going and if this all made sense. If this is a successful method for you, I'd love to hear it. And if you have another idea of how to use the VR levels, let me know. So good luck, guys. Trade responsibly.